Hi everyone, so today I wanted to go over what this comment basically covered. So in my previous video where I was talking about how you can save taxes on your bonus and that you need to be able to do that at the end of the year so you can make sure that you don't actually deduct anything from your actual paychecks. From that particular video, I did actually mention all my methods of saving taxes through your paycheck. I actually decided to cut all of them out because that whole video specifically on the bonuses actually was like majority of the video. So I was like, you know what, I'm just gonna make a dedicated video to this, but make sure you watch that video because it is definitely something that you would want to do and set up before the end of the year if your company allows you, and at least like to be able to be aware if that option is open for you. This video, I'm not a CPA, I'm not a finance professional, but I wanted to at least talk about like how I do it. So that way, if you are, let's say like straight out of college or you were in college or maybe no one ever taught you this. Honestly, there's a lot of content out there, but I was only able to get a head start on this because I sought out these kind of sessions when I was in college. But if maybe you did not realize like it was that important and now you're kind of like, I want to know where to start, but I don't know how to get started, which is a lot of the people that I know, they don't know that. And a lot of the people that I know, they come from immigrant families and none of them even know about this either. I think everyone just knows, like, at least like from the immigrant families that I know, they just say save and do real estate. That's literally all they have. But no one ever talks about all this other stuff about how to save those taxes, how to basically make sure that you don't give the government as much money as you think. Legally, of course. Like, we're not trying to say to basically do tax evasion. We're talking about how can you legally avoid paying as much taxes as you can, and at the same time it's like also helping with your investment. So first things first, I think most people know about this is the traditional 401k. And just for those who may not know, I'm going to just go over very briefly what it is, but if you really want to know what it really is, definitely try to look it up yourself because I'm not a tax expert. I'm also not a financial expert. I'm just going to tell you based off of my experience and my knowledge. A 401k is a tax-advantaged retirement fund. So in this case, a 401k specifically is hosted by the company. It is not something that you can open on your own. You need the company. So in this case, you need to be working at a company that has a 401k or facilitates a 401k. They all work with a 401k provider. So it could be something like Merrill Lynch or Vanguard or Fidelity. In my particular case, I use Merrill Lynch for Accenture. They actually just recently shifted over. And then for Google, we use Vanguard. So they house a 401k plan that is sponsored by the company. And this money is something that you can do many different ways. One is like you contribute money. Sometimes companies do allow you to actually contribute money. And they'll match it. Not all companies match it, but some companies do have it. The good thing about the 401k specifically is that this is actually coming from your pre-tax money. So just to kind of show you the breakdown from last time, you have your total income, which is basically like your actual salary minus before all the deductions, before all the taxes. Then you have all your deductions. Then you have your taxable amount, and then you have your taxes, and then you have your actual net income, the one that actually hits your bank account. So specifically at the top, we have the total income and then the deductions. This is where the 401k would hit, where you're actually taking out, like, let's say in this particular year, it's a $23,000 limit right now, contribution limit specifically for 2024. That means that you are able to contribute up to $23,000 of your own money. Does not include the match. The match could be more than that, but it's specifically $23,000 of your own money can be contributed, and then it would be deducted from your actual salary. So let's give you like a round number of $100,000, $23,000. So now $100,000 was your total income, $23,000 was your actual tax deduction just from your traditional 401k alone. So that means the actual $77,000 is the taxable income. If you did not contribute to your 401k, traditional 401k specifically, then that means that your 100k is being taxed instead. So everyone owes taxes at the end of the day, but when you do this is a tax advantaged account where you're actually not paying taxes right now, but you will pay taxes when you withdraw. So that's a big thing. The traditional 401k or traditional accounts specifically. The traditional IRA is very similar, except the IRA is actually something you can own and manage yourself. the 401k, okay, just to give you like the kind of a step back here, 401k is company hosted or sponsored. IRA is yourself. So you have options in both ways. When it comes to a traditional 401k, it's pre-tax. You are getting the taxes later on, but you are tax deferring it to later on, which means that you are putting in your pre-tax money right now to save your money, or save your taxes at least. But then when you withdraw everything, that means your total full amount plus the growth that it has gone in that 401k, that will be taxed instead. So it's kind of, you have to think about it strategically about, will I have more income back in the future, or will I have less income in the future? So if you think you will have less income in the future, then, okay, I'm actually going to get away from the tax information here. That's a little bit too niche here. Right now, we're focusing about what you could do with your paycheck. Later on, if you want me to go over this a little bit more, I'm only going to talk to you about my experience. But traditional 401k specifically is a company-hosted pre-tax, tax-advantage retirement fund. And this is specifically a investment account. So once you put your money in there and you have your company match, if there is any company match, that goes into the account. You still have to invest in it. It's not just going to be an account. Otherwise, it's just an account with money in there and you're not doing anything about it. I actually use the target funds and I go the most aggressive because I'm still kind of young and I'm not going to retire anytime soon. So I have it on like the target fund of like a little bit most aggressive. So fewer on bonds, more on stocks, a little bit more on the growth stocks, all that kind of stuff. As long as it's growing, I'm fine and I'm contributing it. So I personally, in that 100K, 23K, example, I max it out to the 23K for the contribution. However, this is, and I'm going to talk about specifically what I do because not all companies have this part. It's the after-tax 401k or the Roth 401k. So very similar to what I said about the Roth IRA or Roth IRA. The Roth being is after tax, which means right now you're already being taxed. Like this is after taxes are being deducted. And then that amount that you're actually contributing is going to go into your Roth account. So it could be your Roth IRA or your Roth 401k. The great thing about the Roth 401k is that there's no income limit compared to the Roth IRA. So I was like, I'm going to use this. And I actually do a kind of a half. So the 23K limit that you have, I do half goes into the traditional 401k and half goes to the after-tax 401k. Personally, I don't know if I'm going to be making more or making less in the future, just because like at that time when you're withdrawing cash, I don't actually think I'm living such a very expensive lifestyle because, like I'm going to probably be traveling. I'm probably not going to have as many expenses and now because like, let's say this like mortgage that I have right now will be paid off by then, I think. So I don't think I will be making as much then. I won't be withdrawing as much then. But because of that, I'm like hedging out my chances. I'm like 50-50 onto getting everything pre-tax now, 50-50 when it comes to my after-tax 401k. You're not getting the tax benefits right now, but I will be getting the tax benefits later on. So yes, technically, this is something that you can deduct from your paycheck, but you are not really getting tax benefits right now. But just that's like the main reasoning is like I have a 50-50. For the after tax or the Roth 401k, it does contribute to your total annual limit. So it's not like you could do 23K to the traditional and you could do 23 to the after tax. No, the total contribution actually is the 23K. So in this case, I have half, about like 12,000 per account. Then there's actually the HSA as well. So for the HSA specifically, not everyone has this as well. You have to have a specific health insurance plan or you have to have a specific plan that is eligible for an HSA. So specifically for me, I have the GHIP. So that's like the GHIP. And I think it's like the high deductible one, basically. I don't foresee myself going to the doctor that often right now, at least. Like it's more for preventative care, if anything. So that's why I'm on that. But at the same time, the HSA is something that comes with the insurance plan, or at least I'm eligible because of it. So mine is actually through Health Equity. So this is like tied again directly from the company. When I do my annual enrollment, I'm actually saying like, yes, I want the HSA. With that, you actually get a debit card that comes out of it and you have to contribute to your HSA. So for me specifically, I max out my HSA. I think the limit's like 3,000. I'm going to put the actual number on the screen. but I think the actual limit is 3,000. So I max it out to the 3,000, which means that all of the money that I'm putting in here is also a deduction. It's a pre-tax. So basically that little bracket right before it goes into the deductions and before you actually get your taxable income. So we're reducing that again. So let's say the 23,000 from the 401k and the after-tax 401k plus the 3,000, that's $26,000 right there. I'm removing from the taxable income, and then I'm removing it to have even less taxable income. So you're just getting the base amount of money that taxes are calculated off of will be less. So that's what I have specifically for the HSA. I max it out to the 3,000. I actually, this is the part where it's a little bit controversial. All the people that are like true finance bros or like really into this, they say don't use your HSA for health reasons. Right now, just use it as like, because it's the only way right now where you are actually saving taxes no matter what. You are saving taxes with the pre-tax money going in, and you are actually getting your distributions tax-free as well. It's like the only thing out there that's tax-free entirely. I think the FSA as well, but I don't actually do the FSA. So this is like a really cool way that it's like only 3,000, but it's only health related. I personally just put in all my money in there. I max out to the HSA. I don't like putting in all my money, but I max out the HSA for that exact reason. That I'm like, oh, $3,000, you know, like no big deal. I know I'm gonna need that eventually, like either when it comes to like childbirth or like my own kids in the future or my own husband in the future. Right now we actually have separate insurance and separate plans, so we're not actually using each other's, but right now I'm just like maxing up the HSA as much as I can, and I do use my HSA for all my health costs and health expenses. So that could be like copay, that could be like prescriptions, and that could be like any services, just like acupuncture is all coming from my HSA. So not to mention a lot of companies also subsidize in that. So Accenture, I remember, did $500 a year. They would put in $500 into your HSA. Google does $1,000 to the HSA. So that is like essentially free money that you're using towards your expenses. It is very similar to how if you were to have like a 401k where they're matching, except this is basically, it doesn't matter how much you're committing to contribute. They're giving you that money to your HSA. And the good thing is that like I like that because you're like, oh, you know, free money I could use for another health expense. So that's what I have especially. So I have the traditional 401k, the after-tax 401k, the HSA. So the total max right now is 26,000 with 23k coming from the 401k and then the 3k from the HSA. I don't do an FSA because the one that we have here is for dependent care. I don't have dependents. I wish I could have it towards cat sitting, but that doesn't count. So I don't really do an FSA, but this video is specifically what I do. So I'm telling you, I don't do an FSA, but it is definitely something that you could do. The other thing is like commuter benefits, which is something that I do because I do actually go into the office, but at the same time, I do use it for any other time. So I do the commuter benefit. I used to do it with the MetroCard plus the debit card. Now I just do the debit card because the MetroCard's going away. Like everyone in New York is essentially doing Omni at this point. So for the commuter benefits, this is also pre-tax. So in this case, it's coming from the pre-tax. You can contribute as much as you can. I think there's a certain limit, but I have never gone to that limit anyways to really calculate that. But commuter benefits, it's not necessarily just commuter benefits when it comes to like a MetroCard or anything like that. It works for parking. So if you are in a community where you think you're going to have to park or drive or go anywhere, you can use it towards parking. And specifically commuter benefits, even though it sounds the word commuter, you can use it for pretty much anything transportation related in the US. So let me give you an example that I actually use the debit card, where essentially it's like putting in money directly into this commuter benefits debit card that I can use towards anything commuter benefits eligible. So in this case, I'm here in New York. I use it on the MetroCard, or technically like Omni. So I use it on the subway. I use it on the bus. And that's like just a tap. I have used it on Long Island Railroad. I've used it on NJ Transit, on Path, on Amtrak. And I've even went to, when I was in Boston, I used it on that as well. So it worked on the MBTA. So anything pretty much that you could do, you could pretty much use for commuter benefits. I have actually used this as well when I was in Philly as well for the train. So I think that's like a big game changer as well. So I use that for pretty much not even just commuting, but I just use that for my trips as well. So like when I went to Boston or when I went to Philly, I used my commuter benefits. I got the Amtrak, and I was able to do like pretty much anything with it. So that's what I would recommend. Those are the main four that I use. So I have the traditional 401k, the after-tax 401k, the HSA. I don't do the FSA, but I'm just mentioning it out there, and the commuter benefits. There's also so many other opportunities that are out there. You just need to make sure you look into it. But these are just the ones that I'm aware of and the ones that I'm taking advantage of. So personally, I'm not doing this solely for the tax benefits. Of course I am. Like, otherwise, like, why would I do that to max it out to this point? But at a certain point, you have to think about it, though. It's like, this is the part where it could be like a little bit, it depends on your preference and everything, and it's not necessarily like a actual right or wrong answer, is that how much do you want to contribute right now compared to how much you want to do later on? Because the way that I see it is like, I'm just contributing it mostly for the tax benefits at this point. But you could also think about using like, oh, I could use my money and put it towards like a mutual fund or an index fund and just put a bunch of it into the stock market. It may or may not appreciate more, but just keep in mind that your tax advantaged retirement fund also is invested towards stocks as well. So doing one or the other, one, you're getting the actual tax benefits, and not everyone has access to an after-tax 401k or a Roth 401k. So that's like one way where like maybe you are trying to do the after-tax part so you can have no taxes on the actual gains. So in this case, you could try a Roth IRA, but something to keep in mind is that not everyone is eligible for this. If you make too much money, then you'd have to do a traditional IRA and then convert it to a Roth IRA. That's basically like the backdoor Roth. I don't do that because I have the after-tax 401k. So I'm like, why would I do that? Like contributing $23,000 a year is already a lot. But there's like a lot of matrices out there as to like how much you should be contributing and how much you should have in your retirement fund at a certain point of time. And honestly, it's just a reference. You don't truly know how much money you're going to need, how much money you're going to make. Because like at the end of the day, we never know how inflation's going to be like 30 years down the line. We don't know what health issues might pop up down the line. But again, that's what the HSA is for. The good thing about the HSA is that you will always have it, even if you leave the company. However, when it comes to the FSA, it's use it or lose it by end of the year. So that's the other reason why I don't use it. I don't even have something like for like my glasses, or I don't need it for dental. Like actually my HSA covers for dental as well. So that's something to keep in mind. So let me know down below what you think. What are there other things that you're doing to your paycheck to be able to save on your taxes? And what are you doing specifically for retirement? Like what camp are you on? Are you on saving as much as you can now so you can enjoy retirement later on? Or are you focusing on more about enjoying the now? I mean, still try to save up for your retirement because it does definitely creep up to you and it does compound. So it's definitely worth it to at least go to the matching if your company does match. Like at the very least, that should be what you're doing. So you're getting that free money. But for the most part, like I just max it out anyways. Google does like 50%. So in this case, if you contribute to the 23,000, they're going to contribute to the 1,100, 500 that you have. So I'm like, no, free money. So for them, it's not actually like the amount that you have in your paycheck. It's like based off of the total contribution that you've put in. So that's what I have. But let me know down below, like what other ways that you're doing it. Are you doing it based off of like, I'm going to invest as much as possible in my retirement right now because I can, or later on, maybe you're just like, you know what, I'm going to spend on my money right now and not spend so much money on my retirement. So later on, I can actually just kind of focus on my retirement then. And it's not too late, honestly. It's like, it really depends on the total cost that you might be expecting. But you also have to think about like how much income you might be making now versus later on. So in this case, like your balance of traditional 401k versus after-tax 401k. Most people, from the general guidance out there, I'm not a tax professional, do your own research, is that if you make less than the typical person, or like enough to not take up that much taxes from your income, maybe focus on your Roth 401k or your Roth IRA, because later on you're going to expect to make more money, and that's when you want to focus on maybe like taking out your taxes now when your tax bracket's a little bit lower, and then using your money after tax and then growing it, versus when you have higher income, or if you're, I'm going to use an arbitrary number, but like if you're over 100K in your salary, then maybe you should do it for traditional 401k so you could take benefits off your taxes by like having lower taxable income, since we are taxed at a higher bracket at a certain point. So then you may want to put more in your traditional 401k. I'm not really that nitpicky, so I do 50-50. So What is your thinking about this? Like, are you also doing other things for your retirement? There's also a lot of other benefits that are out there. It's just a matter of what your company provides. But these are just the ones that I know that my company provides. Specifically, I don't take FSA, so I'm not just going to do it because I know I'm going to lose it and the use it or lose it part. So I'm just not going to do that. So let me know down below and see you next time.